Have you ever wondered how people turn a little bit of money into a fortune, or why the rich keep getting richer? The secret isn't luck, it's investing. And guess what? Investing isn't just for the wealthy, it's for you too. Leaving. Your money in a savings account might feel safe, but it's actually costing you. Inflation eats away at your savings, while smart investments make your money work for you. Investing can help you buy your dream house, retire early, and even secure your kids' future. So let's break it down step by step on how you can start building a strong investment portfolio today. Section 1. Understanding your financial goals. First things first. What do you want your money to do for you? Are you saving for a vacation, a new car, or a comfy retirement? Defining your financial goals is key to choosing the right investments. Your risk tolerance is also important. If market ups and downs make you nervous, you might lean towards safer investments. If you're okay with risk for higher returns, you might go for stocks. And don't forget about your time horizon, how long you plan to invest. Longer timelines allow for more growth potential. Section 2. Asset allocation, diversifying your portfolio. Now let's talk about the golden rule of investing. Diversification. Think of it like this. Would you put all your eggs in one basket? Nope. The same goes for your investments. There are different asset classes. Stocks, higher risk, higher reward. Examples: Apple, Amazon, Tesla. Bonds, lower risk, steady returns. Examples: U.S. Treasury bonds, municipal bonds, corporate bonds. Real estate, tangible assets with long-term growth potential. Examples: rental properties, REITs, real estate investment trusts. Commodities, physical assets that hold value over time. Examples: gold, silver, crude oil, agricultural products, cryptocurrencies, digital assets that have gained popularity. Alternative investments, other options that don't fit traditional categories. Examples: private equity, hedge funds, collectibles like art and wine. A mix of these can help you balance risk and reward depending on your goals and comfort level. Section 3. Choosing investments, making informed decisions. Okay, so what do you actually invest in? Let's break it down. Index funds and ETFs. Great for beginners. They track the market and have low fees. Examples: S&P 500 ETFs, SPY, VOO, Total Market ETFs, VTI. Mutual funds, actively managed but come with higher fees. Examples: Fidelity Contra Fund, Vanguard 500 Index Fund. Individual stocks, higher risk but also the potential for huge returns. Examples: Palantir PLTR, Apple, AAPL, Microsoft, MSFT. Dividend stocks, provide steady income along with growth. Examples: Johnson & Johnson, J&J, Coca-Cola, KO, Procter & Gamble, PG. Bonds, lower risk, fixed income investments. Examples: U.S. Treasury bonds, corporate bonds like Apple bonds. Real estate investments, generate passive income through property ownership. Examples: rental properties, REITs like Realty Income, O. Cryptocurrencies, digital assets with high volatility. Examples: Bitcoin, BTC, Ethereum, ETH. Before you put a single dollar into an investment, research it. Look at past performance, fees, and risks. Never invest in something you don't understand. Section 4. Building and monitoring your portfolio. Now, let's put it all together. Opening a brokerage account is your first step toward investing. Here's how to do it. Choose a brokerage. Platforms like Fidelity, Vanguard, Robinhood, Charles Schwab, and E-Trade offer brokerage accounts. Compare fees, features, and user-friendliness. Decide on account type. A standard taxable account gives you flexibility, while an IRA, individual retirement account, offers tax advantages for long-term investing. Fund your account. Transfer money from your bank account to get started. Many brokerages allow you to start with as little as $1. Select investments. Based on your goals and risk tolerance, choose stocks, ETFs, or other assets to begin building your portfolio. Start small and grow. You don't need a fortune to invest. Start small, stay consistent, and reinvest your returns. But investing isn't a set-it-and-forget-it game. Keep an eye on your portfolio, rebalance when needed, and make sure your investments stay aligned with your goals. And if you ever feel lost, don't hesitate to seek professional advice. Investing is the key to building long-term wealth, and the best time to start is now. Drop a comment below. What's your biggest investing goal? And don't forget to like, subscribe, and hit that notification bell for more money-making tips. See you in the next video.